It's time for our year-end review and prediction show. Ted is here to review our predictions from last year, and we'll give you our predictions for 2022 starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. It is time for our annual year-end review show and predictions for 2022. And I know why you and I do this episode. We want to know what's going to happen because we got a business to run here and we have to know what to predict here at Hoyes and Michalos. Why should anyone else care what we think is going to happen next year?
Well, what we're talking about in this show is our predictions of what's going to happen in the insolvency world, but it's an indicator of the economy as a general item. I mean, is the economy going to be strong? Should you be looking for a new job or a second job? Should you be paying down your mortgage or saving for retirement? Should you be selling off your investments to get them out while the market's peaking? All of that stuff is indicative of what's going to happen in the insolvency industry. So listening to us may sound counterintuitive, but we are one of those indicators of what's going on in the general economy.
The canary in the coal mine. And so on a scale of 1 to 10, how confident are you about anything we're going to talk about today prediction-wise?
Well, I look back to what we predicted last year, and we don't know what the hell we're talking about. And so I'm willing to go out on a limb this year and say, we don't know what the hell we're talking about. My confidence level is very low.
Yeah, and as is mine. And so what we're going to do today is not tell you the answer because we don't know.
Right.
And anybody who's on the TV or the internet or anywhere else, they don't know either.
Pre-COVID, we were pretty good at this. Mm-hmm. One of us or the other would usually get the following year's prediction accurately. But this whole COVID thing is just, it's thrown all the models out the window because you just don't know, how is the government going to continue to support those people that have been affected by this? And that has a ripple effect on every other aspect of the economy.
Yeah, and we are recording this just before Christmas. It's airing on January 1st, 2022. So this is our first show of 2022.
Right.
And between when we record it and when it airs, who knows what will have changed.
Well, we won't have Omicron anymore. It'll be whatever the newest one is.
It'll be the newest thing. And that's the big wild card. We don't know.
Right.
So 2 months ago, we'd never heard of this Omicron thing.
Yeah, and 2 months ago, we were starting to move in the direction that we thought, okay, there's an end in sight.
Yeah, we're all vaccinated, or at least the vaccination rate in Ontario is very high.
That's right.
And so, okay, if we're all vaccinated, then we're not going to get seriously sick, so we can go back to our lives, we can go watch a hockey game, whatever.
Right.
And then here we are where we seem to be moving in a different direction. So last year's show was number 330, and that's as we were moving into the 2020 holiday lockdowns. And you're right. You and I said, we don't know. And
right.
I'll put the clip on Twitter if anyone wants to see what we said last year. So since we are recording this, we do not yet have the November and December stats from the government
but we know what they're going to look like.
Yeah, we've got a pretty good idea. So we're kind of looking at, the first 10 months of the year as our base here. In 2019, in Ontario, personal insolvencies were up 16%. Okay, that kind of made sense, right?
Right.
That was before the pandemic, and the reason they were up is because debt levels were up.
Right. And for anybody who cares, we were up a lot more than that. So we had a pretty good handle on where the world was going, and we were responding to people's needs.
And had the pandemic not happened, probably 2020 and 2021 would have continued to look very similar.
That's right.
In January 2020, personal insolvencies were up 17.5%. Compared to that's what I just said, right?
Year over year.
Yeah,
okay.
they would continue to go up in the same trend. February 2020, up 16.4%.
Right.
Again, same as what was happening the previous. Then boom, of course, the lockdowns happened.
Middle of March, everybody closed.
Bam. So in March, insolvencies were basically flat. They were down a couple of percent because the first half of the month was still sort of normal, and then they collapsed for the rest of the year.
Correct.
So for the period January through October 2020, after being up for the first 2 months of the year, they crashed for 8 months. So that 10-month period ended down 23.7%. Huge drop.
Yep.
2021, well, pretty much the same thing. Obviously, there were huge decreases month over month in January and February because you're comparing to a much higher number. And then down they went from there.
Well, so just so people are clear, so it was down in 2020, and then in 2021, once it caught up to when the pandemic lockdown started, they were down even more.
Right.
Right.
So we've had now 2 years of declining personal insolvencies.
We've got to be back to what, 2006 levels or
Yeah,
something?
we're kind of at like 20-year lows at the moment where we are. So, the economy opened up a little bit in the spring of 2021. So insolvencies were up a little bit. The busiest month was March 2021. There were just over 3,000 personal insolvencies in Ontario, which was only slightly lower than the bottom in January of 2019.
Right.
Which is weird because the spring is always busier than January because we're
tax man coming
and we're past the Christmas season. So October 2019, before the pandemic, 4,247 filings that month. October 2021, 2 years into the pandemic, 2,500 filings, a drop of almost 40%. So that's exactly what you just said, that we had it's been going for 2 years. And if you look at the same numbers, July, August, September, it's kind of the same thing. The 2-year decline is somewhere between 36 and 43%.
Right.
And I'm talking Ontario numbers because that's where we're sitting. If you looked at Canada numbers, they'd be comparable.
Ontario's 40% of Canada, so
exactly.
It's a pretty good indicator.
So that's why we pick on that. So let's do this quickly because we've talked about this before.
Right.
Why is it that we're in a pandemic, nobody's working, everyone's using debt to survive, and yet insolvencies are way down? What's going on?
Well, so the biggest single factor is there's just no pressure on anybody right now. When the government shut down in the middle of March last year, the word went out to CRA to just, stop pressuring people. It's okay to send a letter, make a call, and say, hey, you haven't filed or paid your taxes, but no action beyond that was ever taken. And the action used to be, we would freeze your bank accounts to get your attention, or we'd garnish your wages. That really got people's attention. None of that's happening right now, primarily because it's just not the right time to do it. The courts had a similar issue, right? I mean, the civil courts are semi-active now because we've got stuff going through them, but the degree of activity for getting judgments against people and then again garnishing wages is way, way down.
Yeah, and you're right. Pressure is the big one, and paper is the other, because a lot of this stuff still happens by paper. How does the court issue the court order to send to the person to garnish their wages? Well, it's possible, but it's more cumbersome than it used to be.
Well, and a second reason would be, so all of these folks that were put out of work one way or another, you're legally allowed to garnish EI, but it never happens from a practical standpoint. And you weren't allowed to garnish the supports, the CERB and the CRB.
Yeah.
So even if the courts had been active or CRA had been active, there wasn't anything that they could take from people.
Yeah, really, CRA can garnish pretty much anything, but a regular creditor can't. So now the other thing that we've talked about before that I found fascinating was this household savings rate thing.
Yeah, I think there's more going on here than people realize.
Well, so Q1 2000, and I'll put this chart up, so if you're watching on YouTube, you can actually play the home game. That's why we've got like massive sheets of paper in front of us because of all our massive show prep here. So Q1 2019, the savings rate in Canada was 0.6%, so less than 1%.
I can believe that.
And the savings rate, you take your personal disposable income, you subtract what you spend on consumer goods and services, whatever's left over, that's your savings. You divide that by your disposable income. Well, it was practically zero in 2019.
Right.
But second quarter of 2020, so at the end of the first 2 or 3 months of the pandemic, that number spiked up to 27%.
Mm-hmm.
How is that possible? We're in a pandemic and we're saving all that money.
Well, because during the pandemic, you were able to defer your mortgage for 6 months. You could defer your car payments, your credit card payments. Everything was set aside, and you weren't able to go out and spend any money. I think the Canadian economy is divided into three groups. There's the top third. They don't have a mortgage. They're financially secure. They're in really good shape. I think the pandemic has helped these people. Emotionally, it's made a mess of all of us. But financially, it's helped that top third. The middle third are the folks that are in pretty decent shape. So they've still got mortgages and they've got car payments and these things. But they're in the type of knowledge industries that their income stream really wasn't interrupted. So all of these forms of relief allowed them to do all of these things, increase their saving, pay down debt as much as possible, to put them in a pretty good shape. The third that's being hidden by these top two are the bottom third. The bottom third are the folks that have always been marginalized, that are carrying far too much debt, but that debt is being hidden because there's no pressure on them to pay at this point. So these savings rates, I'm sure they're accurate because it's a government statistic, but it's not showing the true picture. So the top 2/3 have taken advantage of this opportunity to improve their position further. The bottom third are in a holding pattern. I think those folks are probably worse off, significantly worse off. But again, there's no action for us to realize on those the troubles that we're going to see.
Yeah, and we're gonna talk about credit cards in a second.
Yep.
The savings rate, interestingly enough, at the end of the second quarter of 2021 was back down to 14%. So still way higher than it's been,
Right.
but a lot lower than it was at the peak. And that kind of confirms what you're saying, that the people at the lower end of the spectrum they're no longer getting their deferrals. They're no longer getting CERB or CRB. Of course, we're talking a few months back. And as a result, they've had to start depleting their savings.
Well, and there's more to it than that, too. That middle third that's actually in reasonably safe shape, they've adjusted some of their spending patterns. So everyone was terrified, rightly, that they didn't know what the hell was going to happen with this pandemic. But now we've all gotten used to it a little bit. I mean, if you think of how much the sales at Amazon have grown and all this online stuff, it just seems natural to me that saving rates have dropped, and I'm sure that credit card debt's starting to go up again.
Let's take a look. We've got the chart right here. So credit card debt was, if you go back, 10 years, 50, go back as far as you want, up, 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 up. And when you look at this chart, it's kind of interesting because there's a spike early in the year, the kind of the Christmas spending, and then it kind of eases off, and then another spike, another spike, another spike. It's just, there's a seasonal pattern to it.
Yeah.
And then bam, the credit card debt started to collapse basically. And by February of 2021, it was at a 10-year low.
Mm-hmm.
And then, of course, well, not of course, we got the chart here. It has been gradually increasing since then. So since February, when it bottomed out, credit card debt has increased by 7%. So does that surprise you? Obviously not.
Not at all. In fact, I think by the end of 22, it's going to be back on the original curve and this aberration will be gone.
And that's because why?
Because by then, either the economy will have improved enough that CRA collectors are back to work, the courts are back fully active, and people have to start dealing with this debt that they've accumulated. Or, and this is a little bit dark, is that we've all gotten so used to this COVID situation that it's become the new normal. And again, now that it's the new normal, things will return to the old normal.
Yeah, and if I got locked down in 2020, but I was getting CRB or CERB or some other forms of support and I didn't have any money to spend, okay, I was able to get through it. But if now I'm not getting my full hours at work, but I'm not getting the government support, well, then I got to lean on debt to survive.
And the deferrals are over. I've heard no talk whatsoever anywhere about mortgage deferrals again or car loan deferrals or any of that stuff. It's just not on the table.
Well, and you mentioned mortgages, which of course are the other half of real estate. Right. So everybody listening to this show is familiar with the Hoyes Michalos Homeowners Bankruptcy Index, named after Hoyes and Michalos. Yeah. Which I
this was a great indicator back when things were horrible in the world. Right?
Yeah, I mean the index peaked, and this is the percentage of our clients. So this is data that only we have. It doesn't exist anywhere else. The percentage of our clients who are filing an insolvency while they own a home. Mm-hmm. And back in 2011, it was around a third of our clients.
It's a huge number.
But it wasn't a big deal because, well, my house wasn't worth that much. So maybe I had a few $1,000s worth of equity, but I wasn't going to lose my house. So I was able to file. Well, by September of 2021, the index went down to 0.4%, basically zero.
Right.
Meaning none of our clients owned a home.
If you own a house, you're not becoming insolvent.
Right. Because house prices are way up. It's pretty much that simple. So even if my credit card debt has gone up, well, I can get a second mortgage, get a secured line of credit, and I'm good. Right. So, okay. What does this tell us? Where are we at? Well, we got record low insolvencies. Mm-hmm. We've got low collection agency pressure, and we got high real estate prices. Those are facts right now.
That's the situation.
So now we get to go to the prediction section. What do we think will happen in 2022? Now, I want to go on a bit of a tangent here because, it's my podcast. It amuses me. I am of the view that inflation is going to go down. And I talked about this a bit last week on episode number 382. I'll put a link to that episode in the show notes. The inflation rate in Canada in November was 4.7%. Again, as we're recording this, we don't have December numbers yet, but it's much higher than it's been in the past. I mean, historically, over the last 10, 15 years, it's kind of been around 2%. So why is it that inflation over the last year has been going up and going up at an accelerating rate?
Okay. Well, so some simple stuff is the more spending that is going on, the higher prices go. And so it's different types of spending now, but people have adapted to this whole online economy, and so they're spending money again. The big thing that's in the media is supply chain problems. Everybody's hearing about this. I can't get your whatever it is that you need because I can't get it out of Asia or South America or where the hell it's coming from.
Well, and you know exactly what's happening in the automotive industry. If I go to a car dealership, can I haggle? No.
Right.
There's the car.
Yep.
We don't have very many of them, so you can pay full price, and if you don't like it, forget it.
And you can't test drive it. You got to order it from the book, and okay, our production for you is in 4 months.
Right, and hopefully you'll receive it.
You'll like the car. Well, you won't get it in 4 months, but you...
Yeah, we'll tell you. So obviously the supply chain issues our savings rate is declining, credit cards are going up, so that's more people spending. That's a supply and demand thing.
Yep.
Real estate, we talked about that. That's not directly in CPI, so let's not get too deep into the weeds. And then we've got labor shortages.
Right.
So this I find quite interesting. So the projected unemployment rate, 7.5% in 2021, going down to 6.1% in 2022. If more people are working, then that's competition for wages, drives wages up. And sure enough, again, we can throw the chart up here that wages have been increasing over the last number of months. Now, I also think that the money supply has something to do with this. The more money you print, there's more out there. The government is predicting a CPI increase of 3.3% in 2021, 3.1% in 2022. What do you think? Is inflation going to keep going up, or is it going to stop? What do you think?
So one of the driving things behind inflation is the cost of borrowing, right? It's how much does it cost to use other people's money? Well, it's free to use other people's money, then inflationary pressures are pretty low because I can borrow at 1%, 2%. Okay, it doesn't add a lot to my costs. As the government borrows more and more and people rely on more and more debt to finance what they're doing, that naturally drives up the cost of using money, which is inflationary as well. And I think that's a bigger inflationary driver than any of this other stuff. But that's...
So you think that if we're doing this podcast a year from now, that
inflation will be high. In fact, it'll probably be higher than it is right now.
There you go. So Ted's prediction, inflation higher, and right now it's 4.7%. Right. So you're thinking like 5% or something like that.
And inflation doesn't have to scare people as long as you've got income that's indexed to inflation. The problem is all these people get left behind, and costs always go up before income.
Right.
So your expenses are going to increase before you see any more money in your pocket.
Well, and the traditional wisdom is exactly what you just said. We know that in the last year, the government spent $100 billion on the Canada emergency wage subsidy, $75 billion on CERB, plus they've got CRB. So the 2020-2021 deficit is forecast to be around $328 billion.
Yeah.
That would certainly be inflationary. However, I have an opposite view to you.
I know you do.
Because I'm the only one who thinks this way. But number one, the labor force participation rate is declining, meaning there are fewer people in the workforce. Mm-hmm. Now, why is that? Well, one of the reasons is we're getting older. So, the older you get, the less likely you're in. There are some people who've said, you know what, forget about it. I got to stay home with my kids because I don't know if, their schools are going to be locked down again. It's just easier. There are other people who've said, you know what, I'm going to start some kind of side hustle business, so I'm going to get out of it. And if you look at the labor force participation rate over many years, it peaked 15 years ago and is coming down. Mm-hmm. The population, again, I think this is interesting stuff.
Yep.
If you divide the Canadian population up into 5-year age bands, the biggest group is Canadians aged 60 to 64 years old.
I'm in that group now.
There you go. Ted has turned 60. He is now the most common age in the country. You and 2.7 million other people.
They're all my friends.
Those are your peeps. And that's slightly larger than the next age groups, 35 to 39, 40 to 44 years old.
Right.
There are 2.6 million Canadians 65 to 69 years old. So that's a big chunk of people who are either retirement age or close to it. And so I think the older you get, you spend less. You're not, buying new clothes, buying new this, buying new that. That to me is deflationary.
I'm not sure I buy into that because again, you're back to now my thirds of the economy. A third of the people that are in great shape can retire whenever the hell they want anyway. A third are in decent enough shape that they can probably afford to retire, but people are living longer, so they're probably going to keep working longer, maybe at a fewer hours or a lesser rate. And then you got that bottom third that are in trouble, and they're going to keep working until somebody tells them they can't.
So we've presented two completely opposite viewpoints, and what will depend on, I guess, is which segment of the population ends up being bigger.
Demographics never lie, though. So, I mean, if there's nothing else that you want to look into to see what future trends are, look to see what's happening with the population, because they're going to tell you, okay, so we're getting older, so we have to do the services and things that, seniors like me need. I get to be a senior now.
Exactly. Well, we're building more hospitals than we're building schools, because that's what somebody older would use. Now, we also, address this whole issue of money supply, and there's absolutely no doubt that over the last, during the pandemic, the money supply has gone way up.
Right.
And again, I don't want to get into too much detail here, because there's, M3 and M1 and
We're
M2.
not economists. We don't have degrees in economics.
I actually do, but we just play them.
Really?
Yeah, I do. But that was 30 years ago, back during the time of John Maynard Keynes, I think. M3 is more broad, M2 is, whatever. If you just look at M1, which is the most narrow definition of the money supply, and if you look at 12-month growth rates, it was around a 5% growth rate in May of 2019. Okay, that kind of makes sense.
Yep.
It spiked to around 30% between October, 30% from 5 between October 2020 and February 2021. Well,
and you wonder why the stock market went up.
Well, yeah, that was the peak of the spending. Obviously, all the government support that we just talked about. And yes, a lot of people were able to, not a lot, some people, that top third you talked about, were able to take that money, put it in stock markets, real estate, whatever.
Right.
But it dropped back down to 17% in September of 2021. So
still a ridiculous number.
It's ridiculously high, but the trend is now going the other way. So that's my disinflationary theory. COVID, I think, will eventually ease off. I mean, it might take 300 years like the Black Death.
That's right.
But,
I think,
it will eventually get our third booster and our fourth and our fifth and whatever. It'll eventually burn itself out. Even the federal government is predicting lower deficits. Yeah. They're saying that by 2022, it'll only be $58 billion.
And we'll have had at least one more election between then, and those numbers are all meaningless.
They're going to spike right up. The 10-year government bond rate, is going down. More importantly, I think, we have massive debt.
Right.
And if the pressure comes on even a little tiny bit, then I have to start servicing some of that debt. So even if interest rates are zero, I got to make payments on it. Well, if I'm making payments on my debt, I am not making payments on consumer goods and everything else. I've just got less money. So that's why I think deflation is the bigger issue a year from now. So a year from now, you're saying it'll be around 5%. I think we're looking at 2% or less. So when we come back, we'll see. Now, why do we care? Well, because if you have inflation, debt is great.
Right.
Because my asset prices are going up, my house, my stocks, whatever, and the purchasing power of the debt is going down. That's perfect. Mm-hmm. But if inflation eases off, debt is like deadly, right? Because you're repaying it in bad things. So, okay, now, prediction time. We've already predicted a few things, but now we talk about personal insolvency. So my theory, my prediction is that the growth in insolvencies is going to remain flat early in the year because we're comparing to two low years already.
Right.
And I'll put this graphic up on the screen, but I think there's about 8 different waves of things that'll happen. And this is exactly why you can't predict anything.
Right.
Because how can you predict when there's 8 different variables? Like you can't, okay? But
you got to make some assumptions.
And so my assumptions are that we're already into the soft collections phase. And I've had clients tell me this, that the bank phoned me up and they said, I'm not a collection person, but I just wanted to let you know you're a little bit behind. So if you can make a payment, that'd be great. So we're just touching base. Mm-hmm. And that's what they've been doing since about November, and will probably, carry through into January. The Canada Emergency Wage Subsidy ended sort of October, November-ish. And so I suspect that there will be some companies early in the year who will say, well, our work is still down. Our volume is still low. Some industries are booming, others aren't.
Got to make adjustments.
Exactly. And so that, I think, if people are losing their jobs or switching to lower paying jobs, then that obviously impacts insolvency. Now, the Limitation Act.
Right.
So explain why I've put it on this list. Why do I think somewhere around, the spring of 2022, this could be a potential issue?
Right. So the Limitations Act in Ontario basically says a creditor has 2 years to initiate legal action against you from the last date you confirm the existence of a debt. So what does that mean? Well, confirming the existence of a debt, you made a payment, that must mean you thought you owed the money, or if they've got either in writing or a recording of you saying, yes, I know I owe you the money. So they've got 2 years from whatever that date is to initiate legal action, or you have a defense in court to say, well, it's been more than 2 years. I didn't think I owed the money anymore.
Yeah, it's been too long.
And so your concern here is you're pointing out that, well, spring of 2022, we're coming into that 2-year limit. And so unless the government does something to extend the limitation period because of the pandemic, there's going to be a lot of pressure to say, we got to do something now or it's too late.
Right. And so if I'm a big bank, I think in January, I'm going, well, I know a lot of people stopped paying when the pandemic started. I do a soft hit on their credit report, see if I can get any indication that they're working.
Right.
If they are, why not get the lawsuit started now so that at least I've preserved my rights? Now, I don't know if that's going to be a thing or not. I'm merely speculating, but it's something to keep an eye on. We looked at that credit card chart earlier. It always spikes in January. Why? Because of holiday spending.
Yep.
I think the 2021 holiday season, there'll be a lot of people saying, you know what? I didn't get to do anything last year. I didn't get to go see grandma. I didn't travel. This year I'm doing something.
Right.
So I think we will return to a somewhat more normal
January spike.
Does that make sense?
Yeah, I can't tell. I haven't been out and about because, they're encouraging us not to go out and about in the malls and the like. But it seems like there's an awful lot of sales in the media. I thought this year was going to be flat because of supply chains. But it looks like they're desperate to move merchandise. There are places with 50, 60, 70% off on stuff.
Well, and if you look at inventory levels, which I didn't go into that detail here, they have been creeping up because businesses are going, well, supply chain issues, we better load up the pipeline in case we need it.
Right.
And
well, nobody's used to that anymore. Everybody switched to that just-in-time inventory a decade ago, and now they don't understand their carrying costs having inventory.
It's a different thing. So whether the inventory was there for people to buy or not, I guess we'll find out. So then we get into the more aggressive collections activity if their lawsuits are happening. But then we got the big issue, which is your friends at CRA.
Right. That's the thing that's going to tip the scale. Whenever they get back to the office and get back to work, that's when it's going to hit the proverbial fan. And
when we say get back to the office, everyone I've talked to at CRA is working from home.
Right.
And have been since the start of the pandemic.
And due to security protocols and the age of their software and all sorts of other things, I guess is they're less than 50% effective when they're at home.
Yeah, and what we know for sure, it's very difficult to issue a piece of paper.
Right.
They can, but it's more difficult to issue a requirement to pay notice, to garnish your wages, to put a lien on your property. So what they've been doing now is a lot of soft collections.
And I think they've been giving marching orders not to send those things out anyway. Because in the middle of a pandemic, you don't threaten people's houses.
And they certainly weren't going to do it before the election, which is in the fall. So my guess is that at some point, it's like, okay, we finally got to do something. We know that in 2020, 9 million people got CERB with no taxes taken off. Right. So there are a bunch of people from 2 years ago who have a tax liability.
Still haven't filed many of them because there's been no pressure to file.
Well, and certainly haven't paid it because there's currently an interest freeze that you don't have to pay interest on that. Well, now we get to 2021. So in January, February, March, whatever, I file my taxes. And guess what? I got CRB in 2021, which did have 10% taxes taken off. But if I'm in a higher tax bracket than that, I owe taxes.
Right.
And if I made over, and I'm going to misquote the number, I think it's $38,000 in net income, I have to pay back. There's a clawback. I have to pay back half of the CRB that I got. So there will be some people who will end up with a tax liability for 2021 as well.
Right.
So they get those filed in March and April. CRA maybe is back into the office 2 or 3 days a week by April, May, June. Maybe. Well, now all of a sudden, okay, it's been 2 years. Eventually we got to collect this money. And that may be the final straw that tips this thing over the edge.
Well, I'm convinced that that's going to be the straw that tips things over the edge. It's really just a question of when do they get back to work.
Yeah, the interest freeze ends April 30th, 2022. So far, unless they extend it again. But if they start sending out letters saying, well, okay, we haven't been charging you interest, now we are, then I think a lot of people are going to go, okay, I guess I gotta deal with it.
Yep.
And then you already raised the issue of higher interest rates. We have no idea.
Right.
But if interest rates tick up even a tiny little bit, that can be deadly if you're on a variable rate.
As long as the government has to borrow to meet its obligations, interest rates are going to go up because they're the biggest borrower out there.
Yeah, obviously they want to keep them as depressed as possible, so that's why it's hard to figure. But pretty much every expert is predicting somewhere between 3 and 7 rate increases of 25 basis points each in 2022.
I mean, we've had free money for so long, people don't remember that this just isn't normal. And it's not sustainable long term.
Well, and that's probably why we've had inflation in 2021.
Right.
And then, of course, the other thing we don't know what's going to happen is real estate.
You want hate mail? Is that what you want to tell people?
Well,
that their houses are going to go down?
And there is no indication that they're going to go down early in 2022. And
Right.
Ben Rabideau was on the podcast a few weeks ago, and he said that he doesn't see any obvious reason that they are going to be going down in the short term. But medium term, long term, I don't know. Can real estate keep going up 20% a year forever?
Well, I don't remember the real estate cycles. How often do they have their correction? Is it every 10 to 12 years?
Yeah. And
we're overdue.
We're
right?
overdue. And if interest rates do creep up even just a little bit, then that totally changes the economics.
Right.
So in terms of predictions, we've already stated that we don't have the faintest clue.
Yep.
My prediction is that by October of 2022, which will be the numbers we will have access to if we do this podcast in a year, I think personal insolvencies will be 20% higher than they were in October 2021.
Right, because this is a deflated number.
Right. And which still doesn't put them where they were in 2019.
Yeah. So in 2023 or 2024, we get back to where we used to be. Maybe.
Yeah, it will take 3 or 4 years to get back to sort of 2018, 2019 numbers. Now, I think January and February will still be very low.
Yeah, I think once the stats come up, November, December are going to be lower than last year. So again, there'll continue to be a decline. January, February are going to be the same. And then again, it all depends on what happens with CRA.
So we've laid out all the different variables. If we knew what was going to happen with all of those things, it'd be a lot easier to predict.
That's right.
But my prediction is based on, well, I think if this, and this happens, then this is what will happen.
Right.
But of course, I'm going to be wrong on some of those things. So we really don't, don't really know.
And we didn't factor in Omicron. And so the question is, what's the next one?
Right. What's the next thing that could happen? So, okay. So October 2022, what do you think the change will be compared to October 2021?
Well,
I'll just sip my coffee while Ted thinks.
Yeah, I know. You're saying 20%, and that's if the government gets back to work in the summer, that 20% will be low. I don't think the government's going to get back to work in the summer anymore. So I think the union will keep them out.
So you're assuming less than a 20% increase going back. And again, we've showed our work, so you can come up with your own predictions. So any final comments you would like to make on this, the first show of 2022?
Well, the subtext through all of this is you may have heard in our own voices and our responses the level of frustration we're experiencing. That's what everybody's experiencing across society. We've all had enough of this thing. The uncertainty of it, the unpredictability, just the fact that it's difficult to plan when you can't foresee the future. And it's having an impact on all of us. This is no different.
Even though you said there are 3 different groups in society, we're all feeling it. Even the ones who are doing well are also feeling it. And certainly the ones who are most disadvantaged are definitely frustrated. We don't know what we're supposed to do. Are we supposed to wear this or that or the other? And what, how many people can I get together with it? It is very frustrating. All we can do is roll with the punches. Like there's really nothing else we can do. My final comment will be that whether we're right or wrong about inflation and all this other stuff, the lower your debt, the better. Obviously. Unless we go into super hyperinflation, which maybe we will, I think having less debt is good because you're much safer from a cash flow point of view.
Yeah, I mean, a conservative financial plan has always been carry as little debt as possible because then no matter what happens, you can't get into trouble.
Right. If you had no debt leading into the pandemic in March of 2020, well, even if you lost your job, you still had fewer dollars that had to go out every day.
Right.
And that's why I'm a believer in less debt as opposed to more. Ted, thank you very much. We'll see how 2022
pans out
because I don't know. That is our show for today. Welcome to 2022, everybody. I have put detailed show notes on in YouTube. So everything we've talked about, I got a dozen different links. If you want to see where the numbers are coming from, feel free to pull them out. If you are watching on YouTube, please like and subscribe. All other podcast apps, same thing. Like, subscribe, leave a comment. It certainly helps. Until next week when we'll talk taxes, I'm Doug Hoyes. That was Debt Free in 30.